can think of a topic like this when you start writing about it, pension regulation, how fun can that be on a scale? And when you start digging into it, you realize that if you want to do something about a pension system, regulation is one of the few things that actually can drive changes and going to have a large impact. So I started to dig into this and trying to say, how can you present this in a kind of a meaningful way? Because there's so much details in it that if you get bogged down into them, you can't really see the forest for all the trees. So I was trying to give you a bit of the practitioner's view on it, but I also have the luxury of sitting on other chairs. So I'm a board member in one of the Swedish pension funds, in one of the buffer funds. So I heard a lot about that here today, so I think I'm going to say a little bit about that. I work as a practitioner in the Netherlands, so I can say something about that as well. And I'm also kind of interested in research. So when you look at the world from different angles, you start seeing a lot of things that, people have a different view depending on where they sit. And I have 3 points I'd like to highlight in my presentation today, and it's also in the paper. I think the first point is the whole idea with the European regulation is to close the gap between the regulatory risk and the economic risk you're having on the balance sheet. That's point number one. Point number two is that defined benefits are dead. They're gone. And it's not because of the regulation that people say, well, the regulation is here, you can't afford it. It's because of the trends we heard about earlier today. That's what's killing it. And the third point is, which also is very important when you think about regulation, which is a big problem the regulation doesn't address. If you have a collective risk pool, how do you make sure that people in the risk pool are treated fairly? That you do not send the bill to the unborn to pay for the pension. And that is something you don't really hear so much about in the regulatory frameworks. So those are if I would kind of stop now, that would be, now you got the core message. I'm going to elaborate a little bit more. So if you look at the trends, we heard today we're going to live longer. That's good news for us. And that women give birth to fewer children later in life. So we have a tail of the population which is quite a lot of people, and there's not so many people coming in on the other side. This is not something new. You could have seen this 20 years ago. You just look at how much people are born and the trend and realize that something has to be done. Another trend which is also important is that people do not work for the same employer anymore. They have a tendency to have, say, 12 jobs in a career. So the concept then of a pension fund is not as natural as it was when you started for 15 years in the factory, retired at 65, died at 68. Then pension was simple. But all these trends and all this problem has been hidden because we had a very nice bull run in the 80s and the 90s. And now we start to see the problems. And when the regulation comes into play, the regulation is more like a thermometer. It shows that we are sick, or pensions are sick. Then there's two things you can do. You can either say, well, change the scale of the thermometer and pretend you're not sick, or deal with it and move on. And I think the idea here with the risk-based regulation is pretty strong. And one of the drivers behind it is to close the gap, as I said. Another driver is to create, in the European Union, a sort of internal market. So there's a kind of strong drivers behind this. And the interesting part with the regulation that everybody talks about the quantitative part, which is important because that's your reserves. But you also have another piece, which is about governance and risk management inside your pension organizations and banks. And then you have a third one, is the communication to the consumer. One big problem is people kind of miss the part of risk management. And that's kind of the reason why many pension funds are in problem. There are also very good examples of pension funds who weather this crisis extremely well. So it's not like there's one way of solving the problem. I was planning to say a little bit about countries that are early adopters. We hear a lot about them, so I'm going to show the flags here, and I put the names of the countries in because it's not that easy all the time to figure them out. Sweden have done a marvelous reform in year 2000. It's probably the best country when it comes to creating sustainable pension. What they've done was they have a large first pillar, which is also income dependent. You have a relatively small second pillar, which is run typically as mutual insurance companies or individual DC. It's quite a deregulated market, and it's fully DC. Also, the public pension is DC. And the beauty of this system is that it's generational neutral. They're really trying to make sure that no generation should subsidize another generation. The reason they were able to implement it is quite fascinating, because they made it as a non-political issue. All political parties got together, we have a problem, let's solve it, and if we all sign the paper, it's not going to be an election issue. So they did it beautifully well. Study it if you have time. The Netherlands is another country which is also mentioned to be one of the top countries in pension. They have a small first pillar, but a large second pillar. The second pillar, what used to be defined benefit pension schemes, you took away the guarantee, and they're now morphing into what we could say is collective DC. Actually, not that far away from the mutual insurance company, because there's no one there to provide a guarantee anymore. So you have to do it with a collective. And it's not an open market. It's you have mandatory participation in these pension funds. Then you have UK. That's also an interesting country, because they have a small first pillar, a small second pillar, and they had defined benefit schemes, which they closed down and replaced with individual DC schemes. And it's quite a market-driven place. So it's a very nice experiment in these four countries, three countries, of how can you solve this problem. So if you really want to study pension solution, study these three countries, because they're different solutions and you might find inspiration. So all of them, what's common with these countries is they all have adopted a risk-based regulatory framework. So if you take Germany and France, they kind of pretend this is not going to happen, so we kind of sit calm. But here's countries who actually took the step forward before the new regulation is in place and figure out what shall we do to protect the people in the funds. You know already that, if you haven't heard these stories, it's marvelous. When I started in the industry in 1999, Solvency II was a hot topic. People talked about the new regulatory framework. Still, it's not implemented. Still it's being postponed. And when you look at that, you can see this is a very difficult matter. So some countries took a step and moved ahead. The interesting piece was that in around 97 or 96, when this was introduced, market rates was above the average accounting rate. So by going into market valuation, you got a better solvency ratio. So in that sense, it was a good timing of introducing it. If you want to know what happened afterwards, well, you know because you were there, we had the global financial crisis. And that was an interesting stress test of these early adopters, because they had a regulatory framework that if you pass at a certain level, these would be the consequences. You had a regulator who were there. You had to report in mark-to-market terms. So when the global financial crisis hit, the equity went down quite a lot. That was not the problem. The real problem came with the euro crisis. With the euro crisis, basically, we printed money like no one else had done before almost, to push down the interest rates, particularly if you're in the northern part of Europe. When the southern part started to have problems, interest rates went down even further. And if you then are in a mark-to-market framework, and you have not hedged your liabilities, you're in deep water. So here's a small example of a stylized Dutch fund. Assuming you're in, I mean, it's not so much in here that is really, really amazing, but you start with a funding ratio of 140. So you're well funded. And then you keep your behavior as you did before. So you hold a fixed mix of assets, 50-50 stocks, bonds, and you just sit on it and do some, active management. At the end of at the beginning of this year, you would have lost 36% units of solvency, and that's massive. And then you're trying to figure out, where did that come from? Falling interest rates is the biggest contributor. a little bit of equities went down, and a little bit of longevity increase according to increasing the tables. So this is a real problem, because when you have a low funding, you start to think, do I have enough money to actually be fair between the cohorts inside? Because if I start paying out pension now full, and I'm falling down further, if interest rates go down further, I'm going to do probably a transfer from the young to the old, because you say, well, market's going to come back, we hope, and productivity is going to come back, and the young going to pay. So why don't we kind of continue paying full pension? Well, the Dutch recognize this problem, and they have done pension cuts for the pension funds who were below 100, just to make sure that the balance between the young and the old are fair. And this is the big problem of the regulatory framework in my mind, is that you only focus on the balance sheet of the provider or the vehicle. You don't focus on the intergenerational fairness in a collective risk pool. As a consequence, the provider says, well, I'm just going to sell DC. No problem, individual DC. No liabilities, just go on and do it. And those who are left providing collective risk pools, if you don't have guarantees in there, what is really the value of that risk pool? And how are these kind of transfers going to go between the different generations? And that's, if I would say, one thing I'm really worried about. Then, of course, you have the other set of people who say, wait a minute, why don't we just use our 4% that we used to do in the past? And, if you do that on the same data in the same time, there's no problem. No solvency has gone down, And look, interest rates going down has been great, because my assets have gone down, my fixed income assets has gone up with 11%. And that offsets the longevity increases and equity losses. So a lot of people want to go back to this old system, because then you haven't got a problem. Well, you do have a problem between the young and the old. And here's also the big problem, is that if you manage a fund and you're stuck in a book valuation, you do not manage risk, because you think it's a good thing that interest rates went down because my assets went up. Instead of realizing, oh my God, this is going completely to hell. And what you saw in Europe, that some people change the behavior, and those funds are doing well, and others are not. So when, of course, now I'm in America and I have to, give you something to think about, so I will conclude with the following remark. Assuming that you are a civil servant of an American public pension scheme. I took some sort of stylized fund, so this is not a specific fund, which has a coverage or solvency of 60% and an expected return of 8% as a discount rate. If you put the numbers in, here's what you're going to see. If you go to the Dutch 4% actuarial rate, you fall to 31. If you use the swap curve in the US, at the beginning of the month, you're going to have 24%. That means a quarter of all your promises are in the fund if you do proper mark-to-market. The rest of the money, you must hope the taxpayer will bail you out. So if you are a worker in a public scheme, you really have to have faith in the taxpayer, or you should be seriously worried. Thank you.